Welcome to Windfall Edutech Intermediate Module, Chapter 2, Fundamental Analysis. Fundamental Analysis (FA). Objectives of FA. 3 types of FA. Advantages, disadvantages, fundamental analysis versus technical analysis. Industry analysis, company analysis, understanding financial statements, financial ratios, liquidity ratios, asset turnover ratios, financial leverage ratios, profitability ratios, dividend policy ratios, how to use financial ratios, annual reports and its importance. There are 2 types of analysis done for stocks, that is, fundamental and technical analysis. It is a method of measuring the intrinsic value of the company with regards to economic, financial and other qualitative and quantitative factors. Fundamental analysis aims at taking all the possible factors into consideration that might impact the value of the stock. To conduct a company's stock valuation and predict its probable price evolution. To make a projection on its business performance. To evaluate its management and make internal business decisions. To calculate the credit risk of company. At the company level, fundamental analysis involves examination of financial data, management, business concept and competition. At the industry level, there is an examination of supply and demand forces for the products offered. For the national economy, fundamental analysis might focus on economic data such as inflation, GDP etc. to assess the present and future growth of the economy. Fundamental analysis is good for long-term investments based on long-term trends. The ability to identify and predict long-term economic, demographic, technological or consumer trends can benefit patient investors who pick the right industry groups or companies. Sound fundamental analysis will help identify companies that represent a good value. Legendary investors such as Graham and Dodd, Warren Buffett and John Neff are seen as pros of value investing. Fundamental analysis can help discover companies with valuable assets, a strong balance sheet, stable earnings, and staying power. One of the most fruitful reward of doing fundamental analysis is getting a deep insight into the business of the company. A good understanding can help investors avoid companies that are prone to shortfall or hiccups and identify those that continue to deliver. In addition to understanding the business, fundamental analysis allows investors to develop an understanding of the key value drivers and companies within an industry. A stock's price is heavily influenced by its industry group. By studying these groups, investors can better position themselves to identify opportunities that are risky, growth-oriented, value-driven, cyclical etc. By understanding a company's business, investors can better position themselves to categorize stocks within their relevant industry group. By believing that prices do not accurately reflect all available information, fundamental analysis seeks to capitalize on perceived price discrepancies. FA may offer excellent insights, but it can be extraordinarily time-consuming because of whole lot of information that needs to be collated and the subsequent research that needs to be done. Since different companies and industries require a unique valuation model, which will take away chunk of time and limit the amount of research that can be performed. Fair value is based on assumptions. Any changes to growth or multiplier assumptions can greatly alter the ultimate valuation. FA involves use of information about the global and national economies, and the financial state of the companies involved, as well as non-financial information such as current political and weather information. It believes on the adage that the markets will react to events in certain ways and future market prices can be predicted based on these events. It is used to make an investment. TA involves use of trading information, such as previous prices and trading volume, along with mathematical indicators to make their trading decisions. It believes on the adage that all of the information about a market is already included in the price movement, so there is no need any other fundamental information. It is used for a trade. FA takes a relatively long-term approach to analyzing the market compared over years. It starts with the financial statements, at the basic level. Its analysis involves use of long-term time frame, and thus the data used to analyze the stock is generated slowly. TA can be used on a time frame of weeks, days or even minutes. It's at the most basic level. A technical analyst approaches a security from the charts. It is fast-paced generation of price and volume data used in technical analysis. Company is as good as its industry is. Knowing about the industry in which company operates in detail will enable the investors to gain deep insight about the company and its financial health. Some companies serve only a handful of customers, while others serve millions. It would be a downer if a business relies on a small number of customers for a large portion of its sales, since the loss of each customer could dramatically affect its revenues. Present market share of the company can tell volumes about a company's business. Large market share of the company implies that it is one of the largest players in the market, whereas small market share implies that company looks like a dot in its industry picture. Another important thing to determine about the industry is that, whether the customers in their overall market will grow or not. Without the new customers, a company's growth will become stagnated and company will need to resort to manipulative practices to snatch others' share of the pie. It is very important to observe the number of competitors that the company has in its industry. Industry will know or limited barriers to entry and scores of competing firms signals non-conducive operating environment for the firm. Another important thing to find about the industry is that whether the industry is heavily regulated or not. Heavy regulations may serve as a deterrent for potential investors. Before moving on to read the financial statements of the company, it is very important for an investor to know the business model of the company. Next important thing is to check as to what is the competitive advantage that the company boasts vis-a-vis its competitors. Try to find out more about the promoters and management of the company. Assess the companies on the basis of corporate governance levels practiced by them. A company with good corporate governance practices will always be one step above the rest. Apart from the above qualitative factors, fundamental analysis involves use of quantitative factors of company. That is, three most important financial statements, namely balance sheet, profit and loss account, cash flows. Before reading the financial statements, make sure that you have the annual report of the company. There are three statements that you need to look into detail, i.e., profit and loss account, balance sheet and cash flow statements. Balance sheet gives a snapshot of the company's financial condition. In the balance sheet, there are various items such as fixed assets, current liabilities, long-term loans, and shareholders' funds. In your graduation, you must have studied different kinds of financial ratios. Cash flow statements will give you an idea about the cash flow cycle of the company. Cash flow is necessary for the survival of the company. If the company has sufficient cash in hands, they will be able to repay their creditors. Any company with huge amount of cash reserves will always catch the fancy of an investor. However, make sure that the company is sitting on these reserves only because it does not have any other ideal avenue for investment. Financial ratios are useful indicators of a firm's performance and financial situation. Most ratios can be calculated from information provided by the financial statements. Financial ratios can be used to analyze trends and to compare the firm's financials to those of other firms. In some cases, ratio analysis can predict future bankruptcy. Financial ratios can be classified according to the information they provide. The following types of ratios are used on frequent basis: liquidity ratios, asset turnover ratios, financial leverage ratios, profitability ratios, dividend policy ratios. Liquidity ratios provide information about a firm's ability to meet its short-term financial obligations. They are of particular interest to those extending short-term credit to the firm. Two frequently used liquidity ratios are the current ratio or working capital ratio and the quick ratio. The current ratio is the ratio of current assets to current liabilities. Current ratio equals current assets, current liabilities. Short-term creditors prefer a high current ratio since it reduces their risk. Shareholders may prefer a lower current ratio so that more of the firm's assets are working to grow the business. Typical values for the current ratio vary by firm and industry. One drawback of the current ratio is that inventory may include many items that are difficult to liquidate quickly and that have Uncertain liquidation values. The quick ratio is an alternative measure of liquidity that does not include inventory in the current assets. Quick ratio equals current assets, inventory, current liabilities. The cash ratio is the most conservative liquidity ratio. It excludes all current assets except the most liquid, cash and cash equivalents. Cash ratio equals cash plus marketable securities, current liabilities. The cash ratio is an indication of the firm's ability to pay off its current liabilities if for some reason immediate payment were demanded. Indicates of how efficiently the firm utilizes its assets. They sometimes are referred to as efficiency ratios, asset utilization ratios, or asset management ratios. Two commonly used asset turnover ratios are receivables turnover and inventory turnover. Receivables turnover is an indication of how quickly the firm collects its accounts receivables. Receivables turnover equals annual credit sales, accounts receivable. The receivables turnover often is reported in terms of the number of days that credit sales remain in accounts receivable before they are collected. This number is known as the collection period. It is the accounts receivable balance divided by the average daily credit sales, calculated. Average collection period equals accounts receivable, annual credit sales, 365. The collection period also can be written as average collection period equals 365, receivables turnover. Inventory turnover equals cost of goods sold, average inventory. The inventory turnover often is reported as the inventory period, which is the number of days worth of inventory on hand, calculated by dividing the inventory by the average daily cost of goods sold. Inventory period equals average inventory, annual cost of goods sold, 365. The inventory period also can be written as inventory period equals 365, inventory turnover. Financial leverage ratios provide an indication of the long-term solvency of the firm. Unlike liquidity ratios that are concerned with short-term assets and liabilities, financial leverage ratios measure the extent to which the firm is using long-term debt. The debt ratio is defined as total debt divided by total assets. Debt ratio equals total debt total assets. Debt to equity ratio equals total debt total equity. Debt ratios depend on the classification of long-term leases and on the classification of some items as long-term debt or equity. The times interest earned ratio indicates how well the firm's earnings can cover the interest payments on its debt. This ratio also is known as the interest coverage and is calculated as follows: interest coverage equals EBIT, interest charges. Profitability ratios offer several different measures of the success of the firm at generating profits. The gross profit margin is a measure of the gross profit earned on sales. The gross profit margin considers the firm's cost of goods sold, but does not include other costs. It is defined as follows: gross profit margin equals sales, cost of goods sold. Return on assets is a measure of how effectively the firm's assets are being used to generate profits. It is defined as return on assets equals net income, total assets. Return on equity is the bottom line measure for the shareholders, measuring the profits earned for each dollar invested in the firm's stock. Profits earned for each dollar invested in the firm's stock. Return on equity is defined as follows: return on equity equals net income, shareholder equity. Dividend policy ratios provide insight into the dividend policy of the firm and the prospects for future growth. Two commonly used ratios are the dividend yield and payout ratio. Dividend yield equals dividends per share, share price. A high dividend yield does not necessarily translate into a high future rate of return. It is important to consider the prospects for continuing and increasing the dividend in the future. The dividend payout ratio is helpful in this regard, and is defined as follows: payout ratio equals dividends per share, earnings per share. A reference point is needed. To be meaningful, most ratios must be compared to historical values of the same firm, the firm's forecasts, or ratios of similar firms. Most ratios by themselves are not highly meaningful. They should be viewed as indicators, with several of them combined to paint a picture of the firm's situation. Year-end values may not be representative. Certain account balances that are used to calculate ratios may increase or decrease at the end of the accounting period because of seasonal factors. Such changes may distort the value of the ratio. Average values should be used when they are available. Fundamentals involve reading the financial statements and various other relevant things about the company. Annual report provides a deep insight into the well-being of the company by giving various details about the operations of the company. Thus, it is a must-see for all the investors in order to make a right and well-informed investment decision. As per Warren Buffett, the billionaire super investor, annual reports are extremely important for gauging the financial health of the company. Read the standalone and the consolidated financial statements. Financial statements show the profit and the financial position of the company in this year, compared to the previous year. Make sure to read the footnotes at the end of the financial statements, as they will help you understand certain financial transactions in a better manner. Check the auditor's letter as it kind of seals the financial statements as correct and accurate. Read the management discussions and analysis, which gives an open discussion by the management of the company with regards to the company's past trends. There is also a section in the annual report which gives a brief overview of the company's past dividend history and the stock prices as well. This will help you to see the past trend, which will give you an idea about the future dividend payments and price movements. Annual report is the best instrument that the investors have in order to make an insightful decision while investing in stock market. Thank you. Revise and get ready for the next